At 2:17 this morning, while you were asleep, someone slammed the silver market. In a very short amount of time, we saw a noticeable drop in the silver price. The financial news will call this a healthy correction, a technical sell-off after a strong run. That is a lie. This wasn't a normal market move. It was a calculated, surgical strike, executed in the dead of night when global trading volume is at its lowest. It was designed for one purpose, to keep you from seeing what's really happening in the physical vaults. Because the people who did this know something you don't, the paper price is a cage, and the real metal is already gone. Let's make this personal. That drop wasn't just a number on a screen. If you're stacking 100 ounces, you went to bed $250 richer than you woke up. 1,000 ounces? That's a $2,500 hole in your net worth, vaporized while you slept. But this is bigger than one night's loss. This is about the foundation of your savings, your retirement, the very idea that you can own a real asset to protect your family from a devaluing currency. Because that money didn't just disappear. It was a transfer of wealth, deliberately engineered under the cover of darkness. This isn't a market correction. It's a message. A financial shot across the bow. They're showing you that the paper price you trust has been weaponized, and the wealth you think is safe in physical silver is now directly in their crosshairs. It raises a terrifying question. If they're this desperate now, what did they learn from the last time they almost lost control of the entire silver market? So how is this even possible? How can a global market for a real, physical asset be pushed off a cliff by a ghost in the machine? The answer isn't on today's charts. You have to rewind the clock to 1974. That's the year the COMEX exchange in New York created the modern silver futures contract. It was meant for miners and industrial users to manage risk. But a small club of massively powerful banks saw something else entirely, a way to control the price of silver without ever having to touch the metal itself. They built a system of paper promises, a shadow market that completely dwarfs the physical world. Here's the number to write down. For every 100 ounces of silver traded on paper, there is often less than 1 single ounce of actual registered metal available for delivery in the vaults. Let that sink in. It's a 100-to-1 leverage game, a financial hall of mirrors, where the price you see on your screen is not for silver, but for the asterisk idea of silver. This incredible leverage gives them godlike power. When you and thousands of others start buying physical silver and the price starts to rise, the banks can simply dump billions of dollars in paper contracts onto the market, creating artificial supply out of thin air to absorb the demand. It's the ultimate kill switch for any rally. For 50 years, this system worked perfectly to keep a lid on the price. But what happens when the rest of the world stops believing in the paper promise? What happens when they demand the real thing? The banks built this system to control silver, but they overlooked a fatal flaw, a hidden mechanism that is now turning their greatest weapon against them. The year is 1971. President Nixon looks into a camera and tells the world the US dollar will no longer be convertible into gold. In that moment, the entire global financial system is unchained from physical reality. This created a huge problem for the central banks and their partners on Wall Street. How do you maintain faith in paper money when real money like gold and silver still exists as a measuring stick? You can't just ban it. So you build a bigger, faster, more complicated system to control it. Enter the key players, the COMEX exchange in New York and the handful of bullion banks that dominate its trading floor. They didn't just trade silver. They created a new product, taper tench silver. Futures contracts, options, derivatives, digital promises for metal that in most cases would never be delivered. Think of it like this. For every single ounce of physical silver sitting in a COMEX vault, these banks can write and sell contracts representing 100 ounces, or even more. It's a system of massive leverage, a financial cage. It allows them to absorb enormous buying demand and unleash overwhelming selling pressure, all with paper. They can control the price you see on the screen without ever touching a single coin. For decades, this system worked flawlessly. It kept a lid on silver, containing it, managing its price. But that system has a fatal flaw, an Achilles heel that is now dangerously exposed. The banks know that if enough people demand the real metal instead of settling for cash, their entire paper fortress collapses. The overnight price slams are not random trades. They are targeted, desperate attacks to protect the system. But how, exactly, do they pull the trigger? What is the specific financial weapon they use to orchestrate these crashes in the dead of night with perfect precision? It isn't just about selling. It's about exploiting a hidden mechanism buried deep in the market's plumbing. So how do they pull it off? How does a handful of traders in a dark room dictate the price for a metal dug out of the ground on 6 continents? It's not magic. It's a machine. A brutally effective mechanism I call the paper sledgehammer. To understand it, you have to realize there are 2 silver markets. There's the one you think about, physical metal, coins in your hand, bars in a vault. Then there's the paper market, the COMEX, where traders bet on the future price of silver using contracts. The secret is that this tiny paper market is the thermostat that sets the temperature for the entire physical market, and the big banks have their hands on the dial. Here's how the sledgehammer works, in 3 steps. First, they wait. They don't do this at noon on a busy trading day. They wait for the dead of night, for the low-volume window between the close in New York and the open in Asia. Traders call these the graveyard hours. There are almost no buyers around. It's the perfect time for an ambush. Second, they strike. They dump a colossal amount of paper silver futures contracts onto the market all at once. We're not talking about selling a few monster boxes. We're talking about thousands of contracts in minutes, representing millions of ounces of silver they don't have and never intend to deliver. This isn't a trader trying to get a good price. This is an attack designed to move the price. Third, they trigger the cascade. This flood of sell orders instantly overwhelms the few buyers who are online. The price plunges vertically. That initial drop then triggers a wave of automated sell orders from other computers, what are called stop losses. It's a domino effect, a controlled demolition. In under 10 minutes, they've manufactured a new, lower price for silver for the entire world to wake up to. It sounds like a wild accusation, a coordinated attack to artificially suppress a global asset. But this isn't a theory. The proof isn't in some leaked document. It's written in the cold, hard numbers of the market itself. And when we run them, you'll see the fingerprints all over the crime scene. This machine has a name. I call it the paper sledgehammer. And it works by exploiting the one thing every market needs to survive: a pulse. Think of the 24-hour silver market like a major highway. During New York trading hours, it's rush hour. 8 lanes of traffic, cars everywhere. If one person slams on their brakes, the cars behind them slow down, but the system absorbs the shock. The flow continues. But what happens at 2 a.m.? The highway is empty. It's just you and a few long-haul truckers. Now what happens if a truck jackknifes across all 8 lanes? Total chaos. A single event creates a complete shutdown because there's no volume, no traffic to absorb the impact. That's the paper sledgehammer. Here's how they swing it, step by step. First, the attacker waits for that 2 a.m. window, the low-volume, low-liquidity gap between the New York close and the London open, the empty highway. Second, they unleash the weapon, a massive, concentrated sell order of futures contracts, not physical silver, paper promises. We're talking thousands of contracts, representing millions of ounces, dumped onto the market in minutes. It's the financial equivalent of that jackknife truck. Third, the impact is catastrophic. With no buyers on the other side, the price doesn't just dip, it plummets. This triggers a cascade of automated stop-loss orders from smaller traders, forcing them to sell and pouring gasoline on the fire. The price doesn't find a new level, it falls off a cliff. Now let's be clear. The goal of this trade isn't to make a profit. The attacker knows they're getting a terrible price for those contracts. The purpose of the sledgehammer isn't to sell silver. It's to asterisk create the price. To paint a number on the screen that screams weakness and panic, even when the real world is screaming for more physical metal. But that's an explosive claim. How can you or I prove this isn't just a big, clumsy trade? How do we separate a normal market move from a deliberate takedown? The proof isn't in the attack itself. It's in the evidence the attack leaves behind. It's in the numbers that simply don't add up. Let's do the math that the banks hope you never will. Right now, in the registered vaults of the COMEX, the primary exchange that sets the global silver price, there are roughly 35 million ounces of physical silver available for delivery. Write that number down. 35 million. It sounds like a lot, until you see the other side of the ledger. On any given day, there are about 150,000 open futures contracts for silver. Each contract is a promise to deliver 5,000 ounces, so let's multiply. 150,000 contracts times 5,000 ounces per contract. That's 750 million ounces of paper silver. Are you seeing the problem? There are 750 million ounces of claims stacked on top of just 35 million ounces of deliverable metal. That's a leverage ratio of more than 20 to 1. For every single physical ounce of silver sitting in the vault, ready for sale, 20 different paper contracts are pretending it belongs to them. It gets worse. The total amount of silver mined globally last year was about 850 million ounces. Yet, on some days, the paper volume traded on the COMEX can exceed 300 million ounces. Think about that. In a single New York afternoon, traders can buy and sell a paper equivalent of nearly 40% of the entire planet's annual mine supply. This isn't a market. It's a casino built on a fault line, a system this leveraged can't bend. It can only break. The numbers prove the paper sledgehammer isn't just a metaphor, it's a mathematical certainty. The only question is, what happens when someone actually tries to take delivery? This isn't a theoretical exercise, it's a countdown clock. And there are 3 distinct ways this entire paper charade could implode, forcing the price to its true physical value. That 35 million ounces of physical silver is the number they want you to focus on. It sounds big, it feels real, but it's a distraction, a magician's sleight of hand. Because the real action, the number that dictates the price, isn't physical at all. On an average day, the COMEX trades around 180,000 silver futures contracts. Each contract represents a claim on 5,000 ounces of silver. Now let's do that calculation together. 180,000 contracts times 5,000 ounces per contract. That's 900 million ounces. Let that sink in. In a single 24-hour cycle, banks and hedge funds trade paper claims on 900 million ounces of silver. But remember, there are only 35 million physical ounces sitting in the vault to back it all up. This gives us what I call the 25 to 1 illusion. For every single ounce of real, deliverable silver in the COMEX system, there are 25 paper promises floating around being bought and sold. Does that sound like a stable market to you? It gets worse. The entire world, all the mines on every continent combined, digs up about 820 million ounces of silver in a full year. Yet the COMEX trades more than that in paper contracts every single day. They are trading an entire year of global production before lunch. This isn't a market for a physical commodity anymore. It's a high-stakes shell game where the price is set by players betting with chips that can never be cashed in all at once. Because if they were, the game would instantly collapse. This entire paper charade is balanced on a knife's edge. And it only works as long as nobody asks for the physical metal. So what happens when they do? What happens when the illusion shatters? So where does this leave you? This massive game of chicken between a paper price in New York and a physical price in Shanghai can't last forever. Something has to give. As I see it, 2 very different paths are emerging from the fog. Scenario A is the one the banks are praying for. I call it the controlled demolition. They keep using the paper sledgehammer, slamming the price with futures contracts during the quiet hours. They managed to cap silver at $90, maybe $94 an ounce. The physical premiums in Asia persist, but they don't explode. It's a slow, frustrating grind that shakes out the weak hands and convinces you this was all just a bad dream. This is the highest probability outcome, because the banks have the deepest pockets. For now. But then there's scenario B, the black swan. This is what keeps central bankers awake at night. A large industrial buyer, or maybe even a small country, decides they've had enough. They stand for physical delivery on their paper contracts, and the COMEX vaults can't honor the request. The bluff is called. In that moment, the paper price becomes meaningless. The real price becomes whatever someone is willing to pay for an actual physical ounce. And that number isn't on any chart you're watching today. The bankers are betting everything on the first scenario. But the probability of the second is growing with every ounce that drains from Western vaults. Now I know what the skeptics are screaming. They'll tell you this is just a temporary dislocation, a logistical hiccup, that arbitrage traders will eventually close the gap, just like they always do. And honestly, they almost have a point. The first is the path the banks are praying for. Let's call it scenario A, the managed decline. In this future, the paper price stays in a box. They keep it pinned between, say, $88 and $94 an ounce. But in the real world, the cracks widen. The premium you pay for a physical coin at your local shop quietly ticks up from 20% to 30%, then 40%. Major industrial users get told their massive orders will be delayed. The gap between the screen price and the hand price becomes a chasm. The game continues, but the illusion of a single, fair market is dead. It's a slow, managed demolition designed to bleed out confidence without triggering a panic. Then there is scenario B, the delivery default. This is the stress test. This is what happens when a player big enough to break the table decides they've had enough. Imagine a sovereign wealth fund or a massive tech company buys 50 million ounces in paper contracts and does the one thing you're not supposed to do. They ask for the metal. They stand for delivery. This is the moment the entire paper charade collapses. The COMEX would be forced to settle in cash, admitting the physical bars aren't there. A default. In that instant, the paper price becomes irrelevant. The only price that matters is what someone in the real world is willing to pay for the last available ounce. For a decade, scenario A has had a 99% probability. But every overnight slam, every ounce that leaves a Western vault for Shanghai, shifts that probability. We are no longer at 99%. Now I know what the skeptics are thinking. That this is just the market working. That a big sale is just a big sale and there's no grand plan. Now I can already hear the keyboards. The loudest objection to everything I'm saying is that this isn't manipulation. It's just simple economics. And to be fair, it's a logical argument. They'll tell you that silver is an industrial metal, and with a global recession looming, industrial demand is falling off a cliff. Less demand means a lower price. It's Econ 101. Case closed. If that were the whole story, I'd agree with him. But the numbers tell a completely different story. While the television talks about a slowdown, the people who actually build things are buying silver like it's going out of style. According to the Silver Institute's official 2024 report, global industrial demand for silver just hit a new all-time record of 654 million ounces. Total demand was 1.2 billion ounces, the second highest in history. This isn't a forecast. This is the physical reality of solar panel production soaring and the relentless growth of electronics and EVs. So let me ask you a simple question. If industrial demand is so weak, why did it just set a new world record? And why are the physical stockpiles in the vaults of London and New York being drawn down to the lowest levels we've seen in years? You have a market where real users are consuming more physical silver than ever before. Yet the paper price keeps getting hit with a sledgehammer while you sleep. This is the fundamental disconnect. It's a battle between the physical reality of scarcity and the paper illusion of abundance. And it forces you to make a choice. You can believe the price on the screen. Or you can believe the data. I've made my decision. So where does that leave my own money in this tug of war? First, the mandatory part. I am not a financial advisor, and this is not advice. This is simply a look inside my personal playbook, for educational purposes only. Your financial situation is your own. With that said, I treat these overnight takedowns as a gift. My core physical silver position is a long-term holding, about 8% of my total portfolio, and it's not for sale at these paper prices. But I also maintain a separate cash position specifically for these events. My trigger isn't complicated. Anytime the paper price is slammed below $83 an ounce while the physical premium in Shanghai stays wide, I become a buyer. My position sizing is disciplined. I add a fixed dollar amount for every 50-cent drop below that level. I'm not buying paper contracts. I'm buying real, physical metal from trusted dealers. Because I believe the banks are offering a temporary, artificial discount on a real asset. They are trying to shake you out, but they're giving me a reason to get further in. Every ounce they sell on paper to suppress the price is another ounce of physical that gets taken off the market for good. They are holding a beach ball underwater, and the longer they fight to keep it submerged, the more explosive the launch will be when their grip finally fails. So this isn't just a story about numbers on a screen. It's a tug-of-war between a paper promise in New York and a physical bar of metal in Shanghai, and the rope is about to snap. The paper sledgehammer can only strike so many times before it shatters. Every desperate overnight price drop is a signal that the physical market is winning. The banks are running out of time. And so are you. But how will you know when the final break happens? There is one specific trigger. a tripwire buried in the COMEX data that most will miss until it's too late. I'm tracking it daily. Subscribe and hit the bell, because my next video reveals exactly what that signal is. The game is changing. And in a rigged system, the only way to win is to know the rules better than the people who wrote them.